Awesome. Again, thanks everyone for taking the time to be with us. The entire point of value creation, back on the prior slide, please, Tim, is to accelerate efficient growth of your company if you're a strategic CFO, or to accelerate efficient growth of your portcos if you're part of a PE value creation team. As part of our continuing webinar series called Bridging the Gap Between Finance and Go-to-Market, we explore ways that strategic CFOs, as well as PE value creation teams, can better leverage go-to-market data to help in the sales, marketing, and CS leaders accelerate growth, but do so efficiently. A little bit about Scale Matters. CROs, CFOs, CEOs, they generally come to us when they're struggling to get the answers they need to very important go-to-market questions. Questions like, what marketing channel has the best ROI? Our win rate's declining. Why is that? Where are there leaks in our funnel, and what can we do about it? At Scale Matters, we tend to partner with growth and mid-market B2B companies to get them the go-to-market data and analytics they need to be able to take definitive actions to improve outcomes. How do we do that? Step one, by properly instrumenting their tech and ensuring that they've got data capture processes that are in place so they have the data that they can actually trust. And step two, we structure a way to analyze the data to make it easy and efficient to draw actionable insights from. The result, efficient growth. Today's webinar, we're actually going to talk about one of those ways that we structure to analyze data. And it's an approach for leveraging go-to-market data and analytics to improve new logo funnel conversion rates in order to accelerate growth. From an agenda perspective, we'll start by briefly reviewing the components of the SaaS growth model, and then use that model to identify 6 different levers you can push on to drive accelerated growth and efficiency. The bulk of the time we'll focus on one of those levers, which is increasing new logo funnel conversion rates. And then we'll hopefully have some time left over for questions. If we go to the next slide, our Data Drives Action framework is a proven process for transforming our customers' data posture. And as the name implies, it focuses on actions you can take to accelerate efficient growth. It's framed within the subscription growth model, which we'll provide a fairly simplistic visualization of on this slide. The essence of a subscription growth model, of course, is that you have some starting ARR at the beginning of a period. You add to that the ARR from new logos acquired during the period, and those new logos are acquired via a new logo funnel process, which is how we convert leads into new customers and new ARR. Simply put, we run leads through a sales process that converts some number of those leads into new customers, aka deals. And the number of deals times the average ARR of those deals yields the new logo ARR that's added to the starting ARR. Then we subtract the ARR from any customers who either churned or reduce their contract size during the period. Then we add back any increase in ARR that we got from existing customers because of upsell, cross-sell, and expansion opportunities. The effect of all of this, of course, is the ending ARR for the period, which hopefully is meaningfully greater than starting ARR. So the question is, what actions can we take to maximize the ending ARR? And this is where our Data Drives Action framework identifies actions or efficient growth levers that you can push. The first action you can take is to actually drive an increase in the number of leads entering the new logo funnel that actually match your ICP. On the previous webinar we talked about how to use your go-to-market data and LTV CAC calculations to really identify your ICP. If you missed that, you can find a recorded version on our website, or Tim, I don't know if you have access to the link. You could drop that in the chat here if you do. The second action you can take is to balance your resource capacity across the top, middle, and bottom of funnel. What does this mean exactly? It means you should make sure that the number of salespeople and or SDRs you have is appropriate to the amount of ICP leads that you can generate. In the majority of companies we see, they have too many salespeople without enough top of funnel support. And we know this because the sales teams complain about not having enough leads. So what do we do? Management says, okay, well, you'll need to generate 40% of pipeline yourself through your own prospecting efforts. The problem is AE prospecting is not generally very efficient as a top of funnel demand gen strategy. Unless your market is narrowly defined with a finite set of prospective customers and you sell a high ticket item where you could use sort of account-based prospecting. Other than that, it's not a very good top of funnel strategy. And a more appropriate response, if you had too many salespeople, would be to shrink the size of the sales team and reinvest that savings into more efficient lead gen strategies so that you were generating enough ICP leads to support the sales team. This is what we mean by funnel resource balance, and notwithstanding potential internal resistance, this is usually low-hanging fruit at most companies to accelerate growth and efficiency. We're actually going to go into this deeper on our next webinar. The third growth lever is to increase the conversion rates throughout the new logo funnel. That's what we're going to be focusing on today. Before we dive into that, let me just quickly touch on the other three efficient growth levers. Fourth one, you could potentially take actions to increase your average deal size. You can take actions that reduce churn and downsell. And finally, you can take actions that could increase upsell, cross-sell, and expansions. So then the question is, what do you need to know to inform you to take which actions to affect these various levers? And this is where our data drives action framework is very prescriptive in defining what questions you need to be able to answer. For example, if you were focusing on increasing the number of ICP leads that you're generating, there are some very specific questions you must be able to answer. You first need to understand what your ICP is by understanding the ROI on a segment or a profile basis, and that's what the previous webinar was about. Then you need to know the relative ROI of your channels and or campaigns. And that's very different than saying what is the cost per lead by channel, right? Because leads aren't the goal. Sustained high margin revenue is the goal. So you need to understand on a channel level which channel produces the most sustained high margin revenue per dollar invested. And you'll need to understand which channels are the most scalable, because a high ROI channel isn't particularly helpful if you can't actually invest in it more without getting diminishing returns. The point here is that on any one of these levers, these efficient growth levers, you need to answer precisely the right questions, because answering the wrong questions will likely lead you to take actions that are unproductive or worse, maybe counterproductive. So there's three fundamental components, next slide please, Tim, necessary to provide the data to answer these questions, which are going to inform your actions around these levers. One, you will need a way of attributing costs so that you can calculate various ROIs and SaaS metrics such as CAC. Secondly, you'll have to have high confidence full funnel conversion analytics, which will inform your models as well as identify where things are breaking down, and which we'll show you later. And third, you'll need accurate revenue recognition data to help inform you around opportunities to increase net dollar retention. And you'll need to be able to take any of these data points or models and be able to slice it across various operating dimensions. So now let's turn back to our topic of today, which is using a structured approach to data analysis to improve funnel conversion. The new logo funnel, which converts leads into deals, is basically a process, right, or a system. And to best improve the system, we have found it very helpful to turn to a management philosophy known as the theory of constraints. And this theory was introduced by Eli Goldratt through his book, The Goal, which, believe it or not, was originally published back in 1984. But if you haven't read it, I highly recommend it. It is a business book. It's written as a novel, and it really is a great read. But more importantly, The points it espouses are really magnificent and relevant, and they still are today. But the key point of the theory is that the best way to improve any system is to identify the most important limiting factor that stands in the way of achieving a goal, and then systematically improving that constraint until it is no longer the limiting factor. Then you move on to the new limiting factor, and you keep continuously iterating. So we're looking for that choke point, if you will, the most significant choke point that's getting in the way of your goals. When we apply theory of constraints to the new logo funnel, it forces us to ask ourselves, where do we have the most leakage? Followed by, what is the root cause of that leakage? Because it's an understanding root cause that ultimately informs the actions that we could take to fix this stuff. And similarly, we'll want to understand the time elements of conversion across the funnel, as that helps point to friction as well. So, step one, next slide, please. Step one in this process, then, is to identify the limiting factor. And we do that by answering the question of where we have the most leakage. Now, let's consider the simple funnel that's shown here. It has 4 primary conversion points where leakage can occur. First is the conversion from leads to initial meetings that are set up. These are discovery and qualification meetings. Next is the conversion of those initial meetings that are set up to meetings that actually take place, what we call meeting set to meeting held rate, or sometimes it's called meeting show rate. Of those prospects with whom initial discovery meetings were held, some portion of those are converted into legitimate pipeline opportunities. And of those, some portion actually make it through the bottom of funnel process to become a deal or a new customer. But if we're asking ourselves, where do we have the most leakage, we need to modify that question to add context. Are we asking, where do we have the most leakage relative to other parts of the funnel? Well, we could, but most of us design our processes in a way where, by definition, different parts of the process will have different conversion rates. And the step with the lowest rate or relative conversion rate may not actually be the limiting factor. So we really don't like using this as the context for evaluating. Are we asking, where do we have the most leakage relative to industry benchmarks? That would be great. It really would be ideal because it would be helpful to understand where our funnel performance is relative to industry norms. The problem is, unless the benchmarks are from companies that are very similar to your own in terms of things like stage of maturity, go-to-market motions, average deal size, etc., then the benchmarks really won't be relevant and, in fact, could send you in a bad direction. Finding relevant benchmarks in growth and mid-market private company space, it's really tough. And since companies are all over the map in the way they define their funnel processes and kind of the entrance and exit criteria for each step, it's extraordinarily hard to know if you're even comparing apples to apples. So using industry benchmarks really isn't a possibility, unfortunately, in the world of growth and mid-market B2B tech companies. Another frame of context which is actually useful is comparing current period against prior periods. For example, this quarter to date versus prior quarter to date, or versus same quarter to date last year. It will help to identify what has become the limiting factor in your funnel performance relative to prior periods in time, and it could be very valuable information. And then the final way to contextualize this leakage, is by comparing actual performance against planned performance for a given period. And presumably the plan represents the goal. So we like using this context because by answering the question relative to plan, then we're identifying this biggest limiting factor getting in the way of us achieving our goal. So let's go on to the second step. Once we've identified the place in the funnel with the most leakage relative to goal, limiting us from goal, then we want to focus on understanding the root cause. And we do that by evaluating the conversion point across multiple dimensions. The order of this analysis isn't really critical, but we'll usually start by seeing if there are any significant differences in that leakage at this point in the funnel based on the channel that those leads were sourced from. It's not uncommon for us to see very different conversion dynamics from top to bottom of funnel, depending on how a lead was sourced. Next, depending on the nature of the business, we will usually evaluate the leakage at the limiting point across segments. These segments may be geographical, they might be industry vertical, they could be related to ICP profile attributes such as size or stage. They're really whatever dimensions are important to your business. And here again, what we're looking for is, are there any meaningful variations in this leakage at this particular point in the funnel across these segments? Next, we'll typically look to understand if there's a sales execution issue, which often exposes itself as meaningful variations in this conversion rate stuff across sales teams or across salespeople. And finally, we'll seek to understand if there's meaningful variations across the products or services being sold. At a minimum, this dimensional slicing or dimensional analysis of that leakage point begins to expose some correlation that serves as a launching point for deeper analysis. But in many cases, it will actually expose causality, which will lead directly to actions that you could take to improve the outcomes. So let's just summarize this structured analysis, and then I'll show you an example of it. First, you have to answer the question of where is the biggest leakage relative to goal. And you do that by comparing your actual full funnel conversion performance against that which was modeled in your plan. That assumes, of course, that you've built properly comprehensive models for your plan. And then, secondly, you need to answer the question of what is the root cause of that leakage. And you do that by slicing that particular leakage point that you identified in step one across these multiple dimensions, looking for variations across the elements of any given dimension. So I'm going to share my screen now and try to show you this in action. If you just give me a second here. Okay, so to show you how this works, I'm actually going to use our Scale Matters full funnel analytics platform because you can't actually get the conversion rate data directly from the CRM, and it's kind of difficult to show this in a spreadsheet in a webinar. So just view this as here to demonstrate how the process of analyzing this stuff works. So we start by simply comparing the actual full funnel data against what was modeled in the plan. And by the way, in our software, we actually have the full funnel. I've just hidden some of it. I'll just show you quickly what I'm talking about for simplicity. So this is what full funnel analytics looks like, right? So we're looking at volumes of leads, conversion rates from leads to meetings set, and so on down. It's just that I've hidden a lot of the volume metrics in this particular example, and we're focusing on the conversion points, which is where there's conversion rates. And again, we're comparing actual performance on the right to planned or goal performance on the left. And what we're looking for is the biggest negative variation. And if we look at these quickly, the green ones are actually positive relative to plan. So there's three places where we have negative performance relative to plan. This first conversion rate is 26% below plan, not great. The next one's 13.5% below plan. It's okay. But the last one is 50% below plan. So we immediately know that this is our limiting factor. pipeline opportunities converting to deals, also what we all call win rate, right? So the win rate is coming in at half of what we had modeled, and that is so far off of plan that we've got to focus on figuring that out and figuring out how to improve that. So we've done step one. We've identified the most important limiting factor. Now we're going to go into the process of slicing by these various dimensions. And the first thing we're doing is looking at that metric, pipeline opportunities converting to deals, and slicing that by channel. When we do this slicing, we do three things. The first thing we do is we want to understand significance. So this particular customer, they have probably 8 different sourcing channels they use, but the other 4 that aren't shown here, that they're contributing like 2 ops or 1 op or something. So they're not really significant. So we want to focus on the things that are actually meaningful. And in their case, it's organic, it's paid search, it's prospecting by AEs and prospecting by SDRs. And you can see the relative amount of opportunities that are generated by each of those channels. The next chart over is that conversion rate, pipeline opportunities converting to deals based on those channels. And what we're looking for is kind of a mismatch, right? Or variations in that conversion rate. And what we can see is, organic and paid search, ad search, are relatively the same at roughly 6%. But AE prospecting, 2.8, SDR prospecting, 0, right? None of this pipeline is converting that's sourced by SDR prospecting. So we begin to start to form an opinion that maybe, SDR prospecting just isn't working as we expected it to. But the next thing we want to do is take a look at some time context. So now we want to look at how the current quarter, most recent quarter in 2025, these conversion rates by channel compared to all of last year. And what we see here is that all of them are under pressure. So, if it was just a SDR prospecting issue, we'd see relatively straight lines on the other 3, and we'd see SDR prospecting falling off the map. We don't see that here. So it leads us to believe, all right, SDR prospecting isn't probably our best channel strategy, but it's not the reason we're so far off of plan for this pipeline opportunities converting into deals. So we move on to the next dimension that we're going to slice this by. In this case, segment. This particular customer has 4 different segments they track, which is size of prospect, right? SMB, mid-market, emerging enterprise, and enterprise. And you can see that in terms of significance of generating pipeline, SMB is 66 opportunities generated. Mid-market is their biggest, which is 101, and then basically 25 opportunities from each emerging enterprise and enterprise. So SMB and mid-market are the most significant here, but they're all fairly important in this case. If you move over to look at the conversion rates, here again, remember, what are we looking for? Meaningful variations across this dimension in this particular conversion rate. And we see right off the bat that mid-market, 7.2%, way above the other 3. The other 3 are kind of in line with each other, all around 4. So, it's clear to me that this particular company, probably their ICP is in mid-market and could probably do a little bit better job trying to over-index around mid-market. But then the next thing that we do is we say, well, let's look at the trend, just like we did on the channel stuff. And here again, we see sort of a depressed win rate, right? Pressure, but it's across the board. So not one of these things stands out as, falling off the map, which would be the contributing factor to the overall metric being so low compared to plan. So we say, it's not really a segment issue here. Let's go look at the sales team. This company has 2 different sales teams. One is run by JP, the other by BH. JP is a little more prolific. Team JP is a little more prolific in generating pipeline opportunities, but both of them generate a fair amount. But if we go look at the conversion metrics, and these teams are both populated very similarly, right? They have the same responsibility, just different regions. Team JP is converting at almost 4x, more than 3.5 times the conversion rate from Team BH. And we go, wow, this is really weird. Something's wrong here. So what we start to do is we say, well, let's quickly look at those conversion rates for each segment. At SMB, okay, it's a little closer. BH is still lagging, converting at 2.9 versus 4.2%. We go up to mid-market, which is our biggest, that's really our ICP. It starts to get more dramatic, right? 2.9% conversion, 9.8 for Team JP. So it's a very significant difference. And then when we look at emerging enterprise and enterprise, BH isn't getting anything over the goal line. So we start to think that BH is really struggling. Team BH is really struggling with all but sort of the smallest customers here. And then we again go to the trend line, and it sort of confirms our fears. Remember what I said is if these trend lines are all sort of mirroring each other, then it's probably not related to that issue. But if something starts to diverge from the rest, we've got something going on. And we see here in this most recent quarter that Team BH really just fell off the cliff. So we effectively have zeroed in that there's something going on with Team BH here. They're struggling on anything other than, the smallest customers. And we don't have time to do it in the webinar. What we would normally do here is further peel back the onion on Team BH and try to sort of understand whether it's certain people on his team or what's going on to get a little bit more surgical in the corrective actions we choose. But you can see by going through this process of identify the biggest leakage point and then start slicing, through process of elimination, you start to zero in on where there's root cause, which will certainly then inform your actions. And just for a second, I'm going to switch over to a template that we've built. It's a fairly simple template. The first tab is basically step one, identify that limiting factor, right? And this is just plugged in numbers, but it gives you an opportunity to sort of put down your own conversion points, put in your own plan and actual, and it will automatically calculate the most negative variance. And then there's an example of slicing that, right? In this case, an example of how you'd slice this manually by channel. So, not everybody has groovy software that does this for them. So this template will help you. It's kind of a cheat sheet to be able to do this manually, assuming you have the data, of course. So, Tim, let me switch back to you. If you can do that. Yeah, so going back to an earlier slide where we indicated what you will need to be able to do these types of analyses to inform your actions. In the case of identifying funnel leakage and root cause, as we just showed you, you will need to depend on high confidence, full funnel analytics and models that you can slice by the various dimensions we demonstrated. Many organizations struggle with getting their analytics to a sufficient state like this to help them dial in their performance. And if you happen to be one of those organizations, feel free to reach out to us. We can help you get there, and likely far quicker and for far less money than if you try to get there yourself. That wraps up the content. Any questions that we can help you with at this point?
Mike just asked, will you share the template like in the previous webinar? Absolutely, Mike. That will be coming out in an email follow-up in the next day or so. So you'll have that template to play around with. Once you dig into it, if you have any questions as well, feel free to reach out to myself or Scott. I think that's it for now. yeah, we're a couple minutes over time. So thank you everybody so much for joining. I shared Scott's LinkedIn in the chat as well. Feel free to reach out if there's any questions you want to pick his brain on this topic specifically or any others that we've covered. Thank you, everybody.